there, welcome back to Prime Wealth. We're so glad you're joining us today.
Yeah, it's great to have you here. Today, we're diving into something that's been gaining a lot of traction lately: real estate crowdfunding platforms.
Right, and if you've ever thought about investing in real estate but felt overwhelmed by the traditional routes, this might just be the game changer you've been looking for.
Exactly. We'll cover what real estate crowdfunding is, how it works, and some of the key benefits and risks involved.
Plus, we'll share some tips on how to get started, so you can feel confident stepping into this investment avenue.
It's all about making informed decisions, right?
Absolutely. And we know that for many of you, investing can feel like a daunting task, especially if you're over 40 and looking for secure ways to build wealth.
But don't worry, we're here to break it down in a way that's relatable and practical.
So whether you're a seasoned investor or just starting out, we've got something for you.
Let's jump right in and explore the world of real estate crowdfunding.
You know, Alex, it's interesting how real estate has always been considered a solid investment, but with the rise of real estate crowdfunding platforms, it feels like there's now a whole new way for people to get involved without needing a massive upfront capital.
Absolutely, Jordan. For folks over 40, this can be a game changer. Traditional real estate investing typically requires a significant amount of money upfront, which isn't always feasible, especially if you're balancing retirement savings, college funds for kids, or even caring for aging parents.
Right, and with the current economic climate, the kind of return you might expect from traditional savings accounts just doesn't cut it anymore. I mean, inflation is at levels we haven't seen in decades, right?
Exactly. Inflation erodes purchasing power, so if your money's just sitting in a bank account, it's effectively losing value over time. Real estate can be a hedge against inflation since property values and rents tend to rise with inflation.
And with crowdfunding, people can invest in real estate projects for as little as a few $100s. That's a lot more accessible than buying a whole property, especially for someone who might not have the means to invest in real estate otherwise.
Very true. Take, for instance, a listener named Tom. He's in his early 50s and has been focused on building his retirement savings. But with increasing costs and market volatility, he was nervous about his portfolio's performance. He discovered crowdfunding and was able to invest in a diversified pool of properties with a relatively small investment. This not only gave him exposure to real estate, but also helped him feel like he was taking proactive steps towards his financial future.
That's a great example. I think many people can relate to Tom's situation. It's about feeling secure in your financial decisions, especially as retirement approaches. It's a time when you want to see your money working for you, rather than just hoping for the best.
Exactly, and let's not forget the emotional side of investing. Many people over 40 are beginning to think about their legacy, what they'll leave behind for their children or grandchildren. Investing in real estate through crowdfunding can be a way to build wealth that can be passed down. It's not just about immediate returns, but also about long-term security.
And speaking of long-term, the timeline for retirement is shifting too. With people living longer, they're not only working longer, but also needing their savings to last longer. Real estate can provide a source of passive income through rental yields, which can be particularly beneficial in retirement.
Very much so. I've seen clients who have transitioned into retirement using income generated from real estate investments to supplement their retirement savings. They might have a portfolio of crowdfunding investments that yield monthly or quarterly returns, giving them a sense of financial security and reducing reliance on traditional retirement accounts.
It's like this whole new world of investing opens up, especially for those who may not be familiar with the traditional routes. But it's important to remember that while crowdfunding offers opportunities, it also has its risks.
Absolutely. Just like any investment, it's crucial to do your homework. Not every crowdfunding platform is created equal. You want to look for platforms with a track record of successful projects, transparency in their dealings, and a good understanding of the markets they're investing in.
Right, and there's also the importance of diversification. It's tempting to put all your eggs in one basket when you find a project that seems perfect, but spreading your investments across different types of properties can help mitigate risks.
That's a solid point. And consider a woman named Lisa, who was hesitant about investing in real estate. She did her research and found a crowdfunding platform that allowed her to invest across multiple properties, minimizing her risk while still getting that exposure to the real estate market. Now she feels more confident about her financial future.
It's inspiring to hear those stories. It's all about finding ways to adapt and leverage new tools that fit your needs and circumstances. For those in their 40s and beyond, who might be more cautious about where they put their money. Crowdfunding can be a middle ground.
Exactly. It's a way to dip your toes in the water without diving in headfirst. Plus, with the ability to start small, it can be a great way to test the waters and see how you feel about real estate investing without overwhelming yourself financially.
And let's not forget the technological aspect. Many of these platforms provide user-friendly interfaces and resources to help investors understand the market better. It's a lot less intimidating than one might think.
For sure. Many platforms also offer educational resources, webinars, and even community forums. It's like having a support network right at your fingertips. That can be incredibly valuable, especially for those who might feel out of their depth in real estate.
And with all of that in mind, it's really about taking those first steps. For anyone listening who's been thinking about real estate investing but felt unsure, crowdfunding could be a practical option to explore.
Definitely. So as we talk about strategies moving forward, let's consider how to approach this new landscape and ensure that it aligns with your financial goals and risk tolerance. So when it comes to real estate crowdfunding platforms, one of the first things to consider is diversification.
Right, that's a big one. You don't want to put all your eggs in one basket, do you?
Exactly. Think of it like investing in stocks. You wouldn't just buy shares of one company, right?
No, definitely not. So how does that apply to real estate crowdfunding?
Well, you can spread your investment across multiple properties or projects. This way, if one doesn't perform well, the others might help balance things out.
That makes sense. So what's a good rule of thumb for diversification and crowdfunding?
A common guideline is to aim for a mix of different types of properties, like residential, commercial, or even industrial real estate. You might want to invest in different geographic locations too.
I see. So it's about not just variety, but also spreading out risk.
Exactly. And another key strategy is to carefully evaluate the platforms you choose.
What should we look for in a platform?
Start with the track record. How long have they been in business? What's their success rate on projects? Look for platforms that have a history of delivering returns.
And what about fees? I bet that's something people overlook.
Oh, definitely. Fees can eat into your returns, so you want to be clear on what you're being charged. Some platforms charge management fees, while others might take a cut of your profits.
So it's about understanding the total cost of your investment, right?
Exactly. And don't forget about the minimum investment requirements. Some platforms make it easy to start with a small amount, while others might require a larger commitment.
That's important, especially for those just starting out. What's next?
After you've chosen a platform and diversified your investments, it's crucial to stay informed. Keep track of your investments and any updates from the platform.
Right, so regular check-ins on how things are going.
Yes, and don't hesitate to ask questions if something doesn't make sense. Good platforms will have support available for investors.
That's reassuring. It sounds like communication is key.
Absolutely. Also, consider setting goals for your investments. What do you want to achieve in the short term versus the long term?
Right. Having clear goals can guide your decisions. So what's a practical example of setting those goals?
Say you want to build a passive income stream. You might aim for a specific monthly cash flow from your investments.
That sounds doable, and I can see how having that target helps you make better choices.
Exactly. And speaking of choices, you should also assess the risk level of each investment.
How do you gauge that?
Look at factors like the property's location, the developer's experience, and the economic conditions of the area. A solid project in a growing area usually has lower risk.
It sounds like it's a mix of research and intuition.
Definitely. And don't forget to read the fine print. The project details, timelines, and exit strategies should all be clear.
That's a good point. It's easy to gloss over those details when everything seems exciting.
True. It's crucial to understand how and when you can access your funds if you need them.
So knowing the exit strategy is vital. What else should we keep in mind?
Timing can also be important. Real estate markets can fluctuate, so understanding market trends can help you pick the right moment to invest.
Right, so keeping an eye on the economic indicators is part of the game.
Exactly. And if you're investing in a specific project, look for information on its expected timeline for returns.
That's helpful. It really sounds like there's a lot to consider.
There is, but breaking it down into these manageable steps makes it easier.
So what about tools? Are there any apps or resources you recommend for tracking investments?
Sure. There are several investment tracking apps out there. Some allow you to monitor your portfolio and get real-time updates on your investments.
That sounds like a game changer for staying organized.
It really is. And then there are educational resources, like webinars or blogs focused on real estate crowdfunding. Staying educated can empower you to make informed decisions.
Yeah, I think ongoing learning is important, especially in a changing market.
For sure. And as you gain experience, you'll develop a better sense of which opportunities suit your goals.
So, it's a journey, really.
Definitely a journey, and it's one that can lead to financial freedom when approached thoughtfully.
But there are also pitfalls, right? What are some common mistakes people make with real estate crowdfunding?
Well, one big mistake is not doing enough research before investing. Just because a project looks good doesn't mean it is.
So, skipping that research can lead to costly decisions.
Exactly. Another common pitfall is overestimating returns. People can get too caught up in the potential and forget to consider the risks involved.
That's so true. Balancing optimism with realism is crucial.
It really is. And sometimes, investors forget about liquidity. They might lock their money into a project without understanding how long it could take to get it back.
Right, and that can be a shock if an unexpected expense comes up.
Absolutely. So, understanding the terms and the potential timeline is key.
It seems like a lot of this comes down to being mindful and informed.
Yes, and that's what makes the difference in achieving successful investments.
So those are important considerations to keep in mind as we move forward. Now let's bring everything together in the outro. So when it comes to real estate crowdfunding, I can imagine there are quite a few pitfalls people might fall into.
Absolutely, Jordan. One of the biggest mistakes I see is underestimating the importance of due diligence. People often jump into a project because it sounds great or because everyone else is doing it.
Right, like the fear of missing out, or FOMO, right?
Exactly. They might skip over really digging into the details of the investment. Researching the property, the location, the management team. All of that matters a lot.
And what happens when they skip that research?
Well, I've seen situations where investors put money into a project that seemed promising but turned out to be in a declining neighborhood. They didn't realize the area was facing issues like rising crime rates or a lack of development.
Ouch. That must be frustrating to deal with.
It can be. And sometimes investors might look only at projected returns without understanding the risks involved. For example, one investor I know was drawn in by a flashy marketing campaign promising high returns, but didn't consider potential vacancy rates or maintenance costs.
So it's kind of like looking at the surface without going deeper?
Exactly. And then there's the issue of liquidity. A lot of investors don't realize that once they invest, their money could be tied up for years. If they need to cash out, they might find it's not as easy as they thought.
That's a good point. Do you think people misjudge how long these investments actually take?
Yes, definitely. Some projects can face delays, and investors might get anxious when they see their funds just sitting there, not realizing that it's all part of the process.
And that can lead to panic decisions, right? Like pulling out too early?
Exactly. They might pull out at a loss, thinking they need to salvage what they can, instead of riding it out for the potential upside later on.
That's a tough lesson to learn. Are there any other common pitfalls you see?
Another one is not understanding the fee structures. Crowdfunding platforms often have various fees. Management fees, performance fees, you name it. If investors don't fully grasp how those fees work, it can eat into their returns significantly.
So it's like finding out that the ice cream you were excited about has a hidden price tag.
Right. You think you're getting a great deal, and then you realize you're not getting nearly as much as you thought.
And speaking of hidden things, what about the transparency of the crowdfunding platform itself?
Good point. Not all platforms are created equal. Some might not provide enough information about their investment strategies or the projects they're offering. If you can't clearly see where your money is going, that's a big red flag.
Yeah, it's like trying to navigate a dark room. You need some light to see where you're stepping.
Exactly. And it's also important to look at the track record of the platform. If they've had a history of projects failing or not delivering on promises, that's something to be cautious about.
Have you had any experiences with clients or investors who face these issues?
Sure. There was one client who invested heavily in a platform that boasted a lot of successful projects. Turns out, many of those projects were not as successful in the long term as they claimed. The investor felt misled because they didn't do enough of their own research.
That sounds disheartening. Was there a way for them to recover from that situation?
Yes, but it took time. They had to learn to evaluate investments more critically. They started using a checklist for due diligence, looking at the team behind the project, the financials, and even reaching out to other investors for their experiences.
That sounds like a smart approach. So it's about learning from these mistakes, right?
Exactly, and being proactive. It's also important to recognize danger signs early on. If you feel pressure to invest quickly, or if the platform is vague about key details, those should be immediate warning signs.
Yeah, trust your gut. And I guess looking out for overly optimistic projections can also help.
Definitely. If the returns seem too good to be true, they probably are. A reasonable expectation should always be paired with a realistic outlook on risks.
So what about diversification? How does that play into avoiding these pitfalls?
Diversification is key. If you put all your money into one project or one type of investment, you're setting yourself up for a bigger fall if things go wrong. Spreading your investments across different projects or platforms can mitigate that risk.
That makes a lot of sense. It's like having different safety nets, right?
Exactly, and it also gives you a better chance of seeing positive returns overall. If one project doesn't do well, others might balance it out.
So if someone is looking to get involved in real estate crowdfunding, what steps can they take to avoid these pitfalls?
First, create a solid plan. Define your investment goals, risk tolerance, and timeline. Then, do your homework. Research the platform, the projects, and the teams behind them.
Sounds like a solid foundation to start building from.
And don't hesitate to ask questions. If something feels off or unclear, it's okay to seek clarification. A reputable platform will be happy to provide that.
And if they're not, then that's a huge red flag.
Exactly. Be diligent, trust your instincts, and remember, investing is a marathon, not a sprint.
So those are some immediate steps you can take. Now, let's bring everything together with some final thoughts. So now that we've covered the basics of real estate crowdfunding, let's dive into some immediate steps listeners can take, right?
Absolutely. First things first, I'd recommend doing a bit of research. There are several platforms out there, and each one has its own unique offerings. Check out websites like Fundrise, Realty Mogul, or CrowdStreet. They all have different minimum investment amounts and types of projects.
Yeah, and it's important to read the reviews too, right? Seeing what other investors have experienced can really help narrow down your options.
Right. And while you're researching, consider setting up an account on a couple of those platforms. Most of them allow you to browse listings without committing any funds. It gives you a feel for the type of projects they have.
That's a good point. And while you're at it, maybe look into their educational resources. I've noticed that many of these platforms have blogs or webinars that can really help you understand the investment landscape better.
Exactly. And if you find a platform that resonates with you, take the time to understand their fee structure. Some platforms have management fees, performance fees, or other costs that can eat into your returns.
Right. Transparency is key. Now, what about starting small? It can feel a bit intimidating to jump in with a large investment.
Great question. Most platforms have low minimum investments, often starting as low as $500 or $1,000. So you can start small, test the waters, and see how it goes.
I love that. It makes it more accessible, and it also allows you to diversify your investments across different projects, right?
Yes. Diversification can help mitigate risks. Once you're comfortable, you can consider increasing your investments over time, but starting small is definitely a smart move.
So let's talk about some tools. Are there any particular apps or resources you recommend for tracking investments or managing finances?
Sure. There are several personal finance apps, like Mint or Personal Capital, that can help you track your overall financial health. You can link your bank accounts, investment accounts, and even your crowdfunding investments, which gives you a comprehensive view.
That sounds super helpful. Keeping everything organized can really help you stay on top of things.
Exactly. And if you're more into spreadsheets, creating your own tracking system can be a great way to stay engaged with your investments. You can log your contributions, returns, and any changes in the projects you've invested in.
Oh, that's a good idea. Plus, you can customize it according to what matters most to you.
Exactly. And as you build your portfolio, consider setting a regular schedule for reviewing your investments. Maybe once a month, just to see how things are performing and if you want to adjust your strategy.
Yeah, that's smart. Establishing a habit like that can really help you stay informed and make better decisions.
And don't forget about building a network. Connecting with other investors, whether through online forums or local meetups, can provide valuable insights and support.
That's such a good point. Networking can really open up new opportunities.
Plus, you can learn from others' experiences, which can help you avoid common pitfalls.
So what about books? Are there any that you think would be beneficial for someone looking to get into real estate crowdfunding?
Definitely. The book on rental property investing by Brandon Turner is a great resource, even though it focuses more on traditional rental properties. It provides a solid foundation for understanding real estate investing as a whole.
That makes sense. And what about something specifically for crowdfunding?
Real Estate Crowdfunding, How to Invest in Real Estate Without Buying Property by Matthew S. McKinney is an excellent choice. It covers the ins and outs of crowdfunding and gives practical advice.
Those sound like fantastic resources. And let's not forget about the power of online courses. There are platforms like Udemy or Coursera that offer courses on real estate investing and crowdfunding.
Absolutely. Investing some time in learning can really pay off in the long run.
So let's recap some of the immediate actions people can take to get started. Research platforms, open accounts, check out educational resources, and start small.
Yes, and establish habits like tracking investments and reviewing them regularly. It's all about taking those first steps and getting comfortable with the process.
And remember, it's okay to start small and build your way up. It's about finding what works for you and your financial goals.
Exactly. So those are some immediate steps you can take. Now let's bring everything together in the outro. So as we wrap up our discussion on real estate crowdfunding platforms, let's highlight a few key takeaways.
Yeah, definitely. First off, these platforms can really open doors for investors, especially those who might not have the capital for traditional real estate investments.
Exactly. And the second point is diversification. By investing through these platforms, you can spread your risk across different properties and projects, which is a smart move for anyone looking to build long-term security.
Right, and let's not forget about the accessibility factor. I mean, you can start with relatively small amounts, which makes it more approachable for many people.
For sure. And, while the potential for returns is appealing, it's crucial to do your homework and understand the specific risks involved.
Absolutely, and that leads us to the importance of thorough research before diving in. Every platform is different, and knowing the details can really affect your investment experience.
Well said, Jordan. It's all about making informed decisions, right?
Exactly. And remember, building wealth takes time and patience, but every step you take can bring you closer to financial freedom.
So if you found value in today's episode, we'd really appreciate it if you could like, subscribe, and share your thoughts in the comments. And don't forget to share this with anyone you know who's over 40 and looking to enhance their financial journey.
Yes, and next time, we're diving into property taxes, specifically deductions and appeals. It's going to be super informative.
Can't wait for that discussion.
Me neither.
Until then,
take care, everyone.